Hi, my name is Jason Watson with WCG. We are a tax and consulting firm here in Colorado Springs. And today we're going to talk about the C Corporation. We do have a series of videos on basic business entities. We typically focus on the LLC and on the C Corp. Those are the most common that you'll see out there. And today we're going to talk about C Corps. A lot of this material that we have comes from our book. You can get it on Amazon, you can download it on Kindle, PDF copies available as well. Oh, and I want to say we just released our 2020 edition not too long ago, so check that out. That's good stuff. This is a list of some of the common entities that you'll see. A sole proprietor is not an entity, but we'll list it anyway. We have a single member LLC, multi-member LLC, whole nother video on that. In fact, several videos on that. We have LLPs. You don't see a lot of those anymore, in favor now of the LLC. GPs, general partnerships. And we have the C Corporation, which is what we're going to talk about today. And we also have the PLLC and PC, which we'll get into a little bit from the C Corp side. So let's jump right into this. C Corporations are low popularity. They're just not very common. Back in the 60s and the 70s, that was the only thing available. So if you wanted a business, you had to be a C Corporation. LLCs came along the way, and now anybody can go out there and create an LLC. And that's a quick way to launch your business from an entity perspective. Form 1120, okay, is the corporation tax return. If you put an S on the end of that, that's the S Corporation version of the Form 1120. Double taxation still exists. So with the Tax Cuts and Jobs Act of 2017, that was awesome. Huge tax reform for business owners. It was amazing. It reduced the corporate tax rate dramatically down to 21%. That sounds really sexy because you might be sitting there going, well, hey, I'm in the 32 or 35 or 37% tax rate. 21% is lower than that. I should convert my business now to a C Corp. And we'll talk about why that's still a terrible idea. We still have the double taxation. So we have 21% corporate tax rate. That's cool. And then we got the 10 to 23.8% dividend tax rate. The 3.8% on top of the 20% is because of the Medicare surtax. There are some old school, and we'll jump into some examples on that. On payroll for a C Corporation, there is some old school payroll concerns. I want to just briefly touch on them for historical reasons. Back in the day, if you will, before the Tax Cuts and Jobs Act, C Corp rates were very high, and they were commonly higher than your individual tax rate. So what you would do at the end of the year was you would bonus out all of your C Corp profits to yourself, because then it would be taxed at a lower rate. The IRS, it's kind of interesting with the S Corps, as you have learned or could learn on other videos, the S Corp, you want to have a low yet reasonable salary, and the IRS will challenge you if they believe your salary is too low. On a C Corp, the opposite was happening before the Tax Cuts and Jobs Act. The opposite was happening because people were driving up their salaries because, again, their individual tax rate was lower than the corporate tax rate, and the IRS would challenge businesses for paying a too high of a salary. Seems kind of silly. There you go. Today, with the 21% corporate tax rate, we just don't have those kind of issues as much. We still have the reasonable salary issue in S Corp land, and we have several videos on that. Let's jump into this double taxation issue where we believe, and the math will show, that the C Corp remains a bad idea from a taxation perspective. Okay, this is a table that you really probably can't read very easily, and I've expanded on all these, but basically the first band is the S Corp tax effect, the second band is the C Corp tax effect, and then we wrap it up with a summary between the two. Let's drill down a little bit. We have three columns there. We have 100,000, 200,000, and 300,000. Salary, 40, 80, 120. We just took a strict 40%, made it easy. Payroll tax, income tax. You're looking at a total tax for your S Corp of, let's say, on a $100,000 column of $13,100. So keep that in mind. You're paying, let's say, roughly about 13% in tax on your S Corp income with the S Corp at 100,000. Let's talk about C Corp version of this, okay? $100,000 C Corp tax rate, 100,000 times 21%, 21,000, pretty easy. Dividends, that's the balance. That's going to get sent out to you. There's no dividend tax at that rate because the income is so low to you as an individual. We're assuming you don't have any other income sources, so your total tax rate will be, or your total C Corp tax will be 21,000. So this is a table that summarizes this. So at the $100,000 column, we have a 13.1%, if you will, effective S Corp tax rate. And at a C Corp, we have 21%. That's a delta difference of 7.9%. Let's just back up here a little bit and let's go to the $300,000 column. You can see your total S Corp taxes are going to be $62,626. That again is payroll tax and an assumed income tax with no other income tax sources. C Corp, $300,000, we got $63,000 of corporate tax, and then dividend tax is now going to be that 23.8 for a total C Corp tax of $100,000 or $107,000 and some change. So as you get higher in income values, your delta is going to increase. So given our $300,000 example, your effective S Corp tax rate was 20.9, your effective C Corp was 35.9. That sounds horrible, a delta of 15%. So even at the low incomes, it doesn't make sense to be a C Corp. At the higher incomes, it certainly does not make sense to be a C Corp. So don't get drawn into the sexiness of the 21% if that rate is lower than your income tax, okay? Now, you might have to be a C Corp, you might want to be a C Corp, and we'll talk about the reasons why. So there are some benefits to being a C Corp. First of all, you get to keep your income off of your 1040. Why would you want to do that? Well, a lot of reasons. Some people need to maybe not necessarily shelter income, but delay the recognition of income and keep that in their C Corp so they can achieve Social Security benefits, disability benefits, or other things that are income driven or limited based on the income of your 1040. In that situation, you would want to keep all the income in your C Corp and not pay out dividends. And there's some issues with doing that. We're not going to get into it, but there could be some issues down the road if you don't pay some of that money out. Another thing is venture capitalists, okay? The golden rule, yes, do unto others as you would do to yourself, but there's also the golden rule in business, and that basically is he who has the gold makes the rules. So if you're going to an investor, to a venture capitalist, angel investor, these terms are all generally synonymous depending on the decade we're in. If that individual says, hey, I love your idea, I want to invest into you, but the only thing I'm going to do is, or only thing I will do is invest into a C Corp. Well, I guess you're going to be a C Corporation because the golden rule. They have the money, you need it, and they dictate the rules. Employee ownership is another really big reason. WCG actually is a C Corporation, and we pay out our partners a fee for service, and then they carry that money through their own individual S Corps. However, we want to be able to sell stock and give away stock to our staff who aren't partners. And to do that, we felt it was better to do shares of a corporation versus member interest in an LLC. And we can talk about that later in a different video, but employee ownership is one of the big reasons to be a C Corporation as well. And there seems to be looser governance. With a LLC, you have articles of formation or organization, and then you have an operating agreement, which can be very robust and typically is very robust, especially if you have multiple people owning your business with you. C corporations, they have articles of incorporation, they have bylaws, and they have shareholder agreements, and they just seem, from our experience, to be not as rigid. Most things are just dealt with at executive levels, whether it's shareholder voting, whether it's board of director voting, whether it's executive team voting. A lot of things are done referendum and not necessarily legislated within an operating agreement. That's just our experience. You can certainly have a very loose LLC. You can have a very rigid C Corp in terms of the rules and all that stuff. But generally, we see looser corporate governance with a C Corp over an LLC. If you are invested with somebody else, though, you probably want more rigidity and maybe are going to favor the LLC. But anyway, these are the benefits of a C corporation. Not a lot. They're very narrow. they might find their way into your world, but generally speaking, we don't see a lot of C corporations. They're unpopular for the double taxation effect, but again, you might need to have it, and those are some of the reasons that we've come up with. With certain professions, accounting, law, engineer, physicians, depending on your state, you might have to be a professional corporation. So you can't just be a C Corp. I mean, that's what you are, but you also then file an additional document to say, hey, I'm going to be a professional corporation. Some states just recognize that out of the gate. But anyway, for example, Colorado allows a PLLC, which is a professional LLC, and then they also allow a PC. California, however, for example, only allows a PC. So if you're going to be an accountant or a lawyer or a physician in California and you want to practice under that banner of your business, you cannot be an LLC. You must be a C corporation. And even more specifically, you must be a professional corporation. So anyway, just be aware that certain professions in certain states don't allow you to be an LLC, and therefore you're going to have to be a corporation anyway. Just to touch on the S corporation aspect, S corporations are not an entity, they're a tax election on an underlying entity. The Form 1120S is your S corporation tax return. For an LLC, as you've learned elsewhere, or as you will learn, reduces Social Security and Medicare taxes. Those are your self-employment type taxes. For a C corporation, that's on this video, if you will, we want to eliminate that double taxation. If I go back real quick, we want to eliminate these deltas. We want to have the tax being passed through to the shareholder and paid at the individual shareholder's tax rate. We're going to wrap it up. Entity selection is a big deal. As we said, sometimes you have to be a C Corp. Most often people jump out of the gate with an LLC. As we said there, S Corp elections, we've already talked about that. That's going to reduce taxes in different forms. And we also wanted to mention multi-entity structures. As I said before, WCG is a C Corp. We pay out to our partners the profits to their S Corps. So that's a multiple entity arrangement that we've designed, and we've designed several of those alongside other attorneys. We have multiple videos on that, so stay tuned. Feel free to contact us. We can super help you out with all this, okay? Call us at the phone number there. Email us at support@wcginc.com. You can also visit us on our website, wcginc.com, where we have our book, other web pages, blog posts, KB articles, videos, podcasts, all kinds of good stuff for you to visit and to learn about. Again, my name is Jason Watson with WCG, and we'd love to help you. Thank you.
Thank you for watching our video. A PDF of the slide deck is available with the link below. Also, please contact us at 719-387-9800 or email us at support@wcginc.com. Most of our video content comes from our book, blog posts, and website, and is available at wcginc.com. Have a wonderful day.